tips, but finding true wisdom is rarer. Today's guest is here to provide true trading wisdom. Chris is a veteran trader with over 4 decades of trading experience. He began his career in commodities in the 70s and became senior trader at the age of 22 for a U.S. commodity trade house. In the mid-'80s, he opened his own proprietary trading company, as well as providing execution for Tier 1 institutions. His trading expertise is extremely varied: prop trading, multi-leg strategies, and arbitrage. He has trained and mentored traders to become highly successful at prop division of trading institutions, funds, and investment banks. He also created his own trading signal methodology and indicators. Sweet, we've got lots to talk about today. Chris, anything else you'd like to add?
Yeah, no, I think thank you for the introduction, and it's great to be here. Apart from that, plenty of market making as well, which is, again, more of a specialized field. And there's different ways to market make as well. So, so that pretty much covers me, I would say.
Sweet. So, yeah, we got someone who knows the markets inside and out today. That's awesome. As a veteran in this field, what are some of the best tips or advice for the younger generation of traders that are coming up?
Well, as I say during my courses and everything, it's really practice and practice, and then practice some more. You've really got to sort of hone those trading skills. And of course, everyone feels that they're ready to trade before they generally are. So then they start to risk their capital. And that becomes sort of a shame, really, because they just feel that they've got an understanding of trading before they really have. It's so easy to open an account, but it's also so easy to lose that money. And that's why the Nordic Funder is such a great opportunity for guys coming through, because they don't actually have to risk their capital, and they've got to prove that they can get to a certain level before they get access to that capital. So it's a win-win both ways, I think, in that direction.
Yeah, thanks for mentioning Nordic Funder. It's the prop trading firm that we've developed, and one of the things, since you've gone in that direction, I wasn't even planning on it, but since you mentioned it, I do really like it because it helps traders really learn to trade within certain parameters, and I think that's critical for anyone really becoming a successful trader.
Yeah, no, absolutely, and there's so many elements to trading. Whereas watching YouTubes and just looking out there, it's so easy for people to think it's easy. It's like anything, really. When you watch a professional, everything looks so simple. But when you try and do it yourself, it's never so easy. I always put it to sort of like athletics or sport, but even also down to films. You watch, say, a kung fu film, like, going back, okay, I'm old, so, the Bruce Lee ones and all that. You watch them, by the end of it, you think, wow, I can do that. You can kick lights out and do stuff. But, of course, it's impossible. You're going to end up probably breaking your back. But, but you just feel like it just gives you that confidence that you can do that. But in reality, it's just never the same.
Well, yeah, every time a new Fast and Furious movie comes out, the streets are crazy with all the young guys revving up their cars and going nuts, right?
Exactly, doing their donuts everywhere. But taking courses is another thing to sort of really get into, and sort of obviously that's another area of our expertise. But the reason for that is to give these guys a good understanding of what the markets are about before they start to trade, especially if they want to do the challenge as well, because it prepares them.
Yeah, exactly. And like you said, when they watch a professional trader, I think the difference between watching a professional trader is they have all that experience. You don't see the ups and the downs that they go through to get to where they are there. It's like a seasoned captain on a ship. They've got to sail the seas to really know how to steer everything.
Yeah, no, absolutely. And again, back to sports and just in any career and any I mean, it's the same for everybody. But I think also with YouTube, that they're good, they're informative, but they're also dangerous when you're looking at the trading ones, because, you know, a guy sounds as though he knows what he's talking about, but does he really? You know, when you're going to do that, I'm not saying don't do it, but I'm saying, you know, the first thing to do really is to check out their background, find out about them and find out what their experience is to make sure that they actually know what they're talking about.
And you talked a little bit about, I guess, well, in the introduction, we said you developed some of your indicators. Are you able to maybe talk about some of the indicators you developed and maybe some of the thought that went into how you look at the market and how you came up with those?
Yeah, so, you know, with over 40 years experience in the markets, you know, I sort of, I adjust to the market conditions. So, you know, if the markets are volatile, then you know, I adjust my way of trading. If the markets are quiet, I adjust it again, and that's a benefit. And of course, I've got a deep fundamental understanding of the macro picture of the markets as well. So I can blend. So I can either use my macro outlook, which gives me that long-term trend, and then I will use technical analysis to help me with my timing for my interests and such like. And it was at one stage I was a market maker for both the energy exchanges. You know, we was sort of liquidity providers, and we was using a variety of strategies to do that. And it was then that what I wanted was something that gave me an idea of when the market was reaching a support or a resistance level. And, you know, I know that sort of 80–90% of traders actually use candlesticks. And yes, I teach candlesticks, but I actually developed it using points and figure.
What does it say that? What's points and figure? What does that mean?
So point and figure is just made up of noughts and crosses. And it's actually one of the oldest chart types.
Oh, okay.
But it's also one of the most forgotten chart types. But what I like about it is there's no time element. It's just price action.
And when I was down on the New York Stock Exchange, I asked, what's the success? And he's like, just follow momentum. I guess price action tells you where it's going.
Yeah. So my point and figure provides me with support and resistance levels. I can see when the selling pressure's there. I can see when the buying pressure's there to hold the market for that turnaround. And then as an actual momentum indicator signal, then I actually developed one using Heikin-Ashi. So again, Heikin-Ashi is very similar. It's a candlestick, but it's a different form of candlestick. The key difference is the start point of each new candle, because it's actually based at the midpoint between the open and close of the previous candle. So therefore, you'll never get a gap on a Heikin-Ashi chart. But also, you have to be careful and never use it for back testing, because the lows or the highs may not be real. If you've got a wick both ends, then it's fine. But if you haven't, you've just got sort of a flat base or a flat top, that may not be a real high or low because of the start point being the midpoint between the open and close of the previous candle. But I use it for a momentum indicator, and it works great on all different time frames as well.
Wow, very cool. So some people who are attached to candlestick charts, they're not your end all and be all. There's other ways.
You know, even so, if you're using candlesticks, Heikin-Ashi is another form of candlestick. So all it's doing is complementing it. But for me, what I like for it is when I'm in a trade, it really sort of gives me the confidence to stay in that trade because it's got a very smoothing effect to it. You know, creating my sort of trigger on it is sort of when you get a series of candles in the opposite colour. So if it's been a rally, when you start to see that series of red ones coming in, it's a warning sign for me that trend is over and sentiment's changing.
And you just hit on a point. Like my biggest point of failure is being able to really stay in the trades long enough to realize the profit that I want to realize from it. Any tips for that?
Well, yeah, I you know, to be honest, that happens to almost everybody, and even professional traders from time to time. You know, we always want to sell the top and buy the bottom, but it's never that easy, especially when our emotions get involved in our trades. And then sort of, so for me, this is another reason why I created this, because Once you're in that trade, it gives me the confidence to stay in. But as I say, when those colours start to change, it gives me sort of, hey, wake up, be careful here because sentiment's changing a little bit. And then, to protect some of that profit, I'll use a trailing stop, sometimes just a hard stop, or a variation. I'll put some hard and some trailing stops in.
And I guess, how do you go about identifying different trade setups?
So for me, when I'm starting my day, I've done all my analysis. I've read all my reports. Generally, I've written the reports actually because I do my daily newsletter. And then once I've sort of worked all of that out and I'm doing my analysis, I start with a daily, and then that sort of gives me the overall trend of the market. And then I'll reduce that down to a 30-minute chart. Sometimes 240, then 30, and then I'm just sort of honing in and getting to sort of zoom in on the areas of the levels where I'm interested in, and of course I'm going to put a bias on those as well. So it depends, if I've got an uptrend, shall we say, I'm much keener to buy if it's coming down to test the support than I am to sell at the top because it's an uptrend. So you might be selling it at the high now, but I'm going to take less out of that trade. I'll only get, say, 50% of that. Whereas if I buy on the support line, I'll hold on to that for longer, expecting it to go up and test the upper resistance line again.
Yeah, there's nothing like a good little formation, either up or down, happening, and if you can spot those and then figure out where the downs are, and you can always. Those help you buy and sell within those ranges. It's definitely really nice.
Yeah, markets do trend, and they trend very well, and especially sort of even this year. From the start of the year for the stock markets, I mean, they over a 20% sell-off. It just killed the last decades of a bullish trend. Although the markets are recovering now a bit, so that's not so bad. But overall, I just think that, understanding where the trend is gives you opportunity. Understanding by going into shorter time frames, you can see trends within trends. So just, if you've got this uptrend and it's coming down here, a lot of people might start, the ball runs over, it's getting bearish. But that's because they've got a small short-term trend inside that, whereas the pro traders are just being patient, waiting for the market to come down to this support level so that they can get long again, because the bias is to be long of that market because it's a bullish trend.
Yeah, and well, in all the years of experience and expertise, walk us through some of the good moments, the bad moments, the good, the bad, the ugly, good trades, bad trades, highs, lows, because if people are starting up, they think it's all rosy, but you have to be able to walk through the mud a bit and get that and build that confidence up.
Oh, absolutely. And confidence is such a big thing in trading as well. Confidence, emotions, they all come into it. And sort of coming back to when you're starting off and all that, another thing I always say is try all the different asset classes first. Because it's a bit like going into that sweet shop, that candy store. Until you've tried all the flavours, you don't know your favourite. And it's the same with asset classes. They move at different speeds. And it's a matter of finding the one that suits your character the most. And that's really important because you're going to be more comfortable trading that, more confident trading that. And then, once you start to sort of develop your own trading style, then you can start to sort of create your own trading plan, which is obviously just a set of rules. And I'm going to pronounce this badly, but Sun Tzu, which all pro traders have read and experience of, because he was one of the most famous and successful generals and philosophers in history. I don't actually know how many battles he won, but it was either in the hundreds or even more than that. But he was around in about I think it was 588 BC, so obviously a long time ago. But he's got some great sayings, and you should really research these on the internet because they're really worth looking at. But you can relate some of them to trading as well. So some of the ones I like is, for victorious warriors, they win first, then go to war. Whereas for the defeated, they go to war first and then try to win. And when you convert that, what does that actually mean to trading? And it's plan your trade and trade your plan.
Yeah.
And that is a great one. Another one is he will win who knows when to fight and when not to fight. So sometimes, the best trade is no trade.
Yeah. Yep.
And the final one I would say, which is one of Warren Buffett's favourites, is in the midst of chaos, there's opportunity.
That's all very true. Yeah. Oh man, it's sometimes you just like, I've had to take a couple days off trading the other days. I was like, yeah, you know what? I'm just getting beaten up. Time to walk away. And then, because I'm trading, I'm doing some trading, and I have a partner trading with me as well. It's kind of cool. They're able to jump in, and they're like, you know what? I see opportunity here, so they jump in and they take it, and it's really good. We've been finding success, kind of bouncing off each other in it, and I've done that in the past where I've traded with other people, and like sometimes it was just really difficult because no one took responsibility for their decisions or their actions, and in here we're taking complete responsibility for everything, whether it's a loss, whether it's a win, it's all good. And yeah, part of a trading team, I think that's really necessary. But most people are going to be trading on their own, and figure out how to trade on your own first before you trade in a team. But then if you're in a team, I think it's really good to have total accountability.
Yeah, you just have to be a little bit careful in teams. You want sort of people that are probably sort of very much similar characters to yourself. Otherwise, you could end up with opposite sort of views and ways of trading, which don't really complicate. They sort of conflict with each other, and it makes it more difficult.
Yeah, I'm good at trading like the breakouts, and he's better at trading the ranges. So if it's either I'll set orders where it breaks out, and and then it works, or I'll have tight stop losses, so I'll get bounced around and jerked out of the trades, and then he sees that I'm getting jerked around, and he's like, oh, that means it's a range. That means I can take action of that. So it's pretty cool. Yeah. But yeah, I've seen the worst of many things on when trading, because sometimes you'll blame each other for this, blame each other for that, and but especially it works good for us because we're in different time zones. So I can set orders, and we can switch and flip. But yeah, I would say stop losses are super key, and being able to set those and then just forget those. It's really good. So I can sleep and not worry about whatever happens.
Yeah, and stop losses are so important as well. You've got to have your stop loss in the market. You can't have these soft ones where it's in your head. You need them in the market because you never know what's going to happen and when it's going to happen. So you need that safety net. Otherwise, you could just be risking too much of your capital. But what goes in hand, and which isn't talked about as much, is as we discussed earlier, is when to take your profits and how to take those profits. We all focus on making sure we don't lose too much of our capital, or at least we should. But then it's okay. So we need the winning trades because they help to cover and protect us against the losing trade. So again, there's different strategies that can be created to make sure that you do that. When I'm trading, I deal in zones rather than at fixed prices. So I'll identify where my support level is or where my resistance level is. But if you wait for those perfect levels, you don't always get your trade on because other people will be inside your prices because they can see the same as you. And sometimes it's like waiting for all the planets to line up. You just don't get to trade regularly enough. So what I do is I identify, say, where my support level is, and then I'll work out how far inside that I'm prepared to come. That will be my sort of first level. And then I'll have a second midpoint, and then I'll have my final level, which is quite close to the support line. And the idea of that is, as it's coming down, I get my first level, I may get my second level, I might not get my third level because it's too tight on the support line before the market starts to react and reject it, and it goes off. But at least I've got some of that position on, and then I'll probably add to that as the market starts to go in my favour as well. So I deal in zones. So, what I do is I sort of split my volume up into 3 sections. And it's the same when I'm taking profit as well. So, when the market, so let's imagine I've bought and then the market's going in my favour, I'll have something in there as a sell, just to sort of, as a trigger, a little wake up, hey, you're in the money. Think about this. So then it's up into my take profit zone, and then I'm looking at that, and then I'll start to feed in that. But I'm monitoring it live so that I work out how much I can get out of this trade, because I like to maximize my profit in every trade. It's not just, okay, I'm going to get long here and I'm going to sell it out there. I want to maximize that. And another point on that is, when I'm in a trade, I never look at my P&L. I always cover it up. And the reason for that is I don't want to be trading my P&L. Oh, look, I'm up X amount. Oh, that's nice. Oh, I should take that. I don't want that extra sort of emotion going through me. So I cover it up. I've got enough experience that I know how much I'm making in my head, really, anyway, to be honest. But just in general, I want to trade my position. I've worked out where I want to buy it. I've worked out where I want to sell it. I've done all my risk reward and all that. So why should I get out early just because I can see there's money on the table? But the other side of that is you don't want to wait too long. So it's just having that balance. So what I tend to do is sort of feed into a rally, taking profits, but slowly. Sometimes I'll gap out depending on how strong I feel that the push on that market is. Again, just trying to maximize it. But what I'm not going to do is keep saying, oh, I'll wait, and then the market starts to turn and end up taking nothing out that trade. Because for me, that's the biggest sin in trading, is not losing money, because we all do that. And some days it's just not your day. The same as other days, it's, you can't do anything wrong almost. And then it's those other ones in between, those other 8 days where you're trying to sort of battle against the market to hold on to those profits. As we say, making money is easy. Holding on to it is the difficult part.
Oh, you just hit on it's like my experience the other day. I set all my orders. The market's moving, hitting one order, boom, hitting another order, boom. And then all I'm doing is I'm clipping my profits because I'm seeing them and not letting them run. And I would have had such a profitable day. And then I clipped profits early, and then I was chasing everything around afterwards. I was just making mistake after mistake. And it's because I was looking at the profit number. I'm like, let's take it. But I'm like, oh wait, there was more. I left it on the table. So I go and I put an order in that, and I never place manual orders. And I'm starting to place manual orders, and I'm like, what am I doing? And it's going against me. Okay, take the loss. And I'm like, I gave everything back that day, and I was just, if only I didn't look at my profits. I just let the orders do their thing. I was cardinal sin number 1, you say. I feel it.
Yeah, well, when you're sort of talking about those types of things, it's all your emotions coming through. You get into revenge trading sometimes as well. Now, with revenge trading, okay, you've had a series of losses, and then you want to sort of try and make that money back. But, the secret is not to try and make the money back. That's already in another trader's pocket, hopefully mine. But you don't want to sort of keep chasing and compounding the problem. Otherwise, you make too much of a dent in your capital. So the secret there for me is like one of my golden rules is, if I have 3 consecutive losses, because that's unusual for me, I stop trading for at least an hour to work out why. If I can't work it out, I just don't trade anymore today. My philosophy is tomorrow's another day, so I'll come back tomorrow and trade. But, when you're sort of creating that revenge trading, it always ends badly. But for me, there's 2 types of revenge trading. There's obviously the one where you'll keep taking the losses, but for me, there's a second type of revenge trading, and that's you've gone long and the market goes up and you take your profit. Oh, well done, great trade, but then it goes up more. Oh,
that was me the other day.
I should have held on, and then it goes up more. And oh my God, why did I get out of that position? And then it goes up even more. Oh God, I could have had double what this is crazy. It's got to come off now. So then you sell it and you go short, and then it keeps going up, and you end up getting stopped out, and you've wiped out your whole day. For me, that's revenge trading, because what you're doing is saying, I took my profits too early, so I'm going to sell it now in the hope it comes back to where I got out of my original longs. And then I've wiped that bit out. So really now I've sold it down there, and I've bought it down there, and I've sold it up there, and the bits in the middle just wash out. And for me, that's a form of revenge trading.
Well, fuck me. God damn, I've done that before. Damn. It's good to identify it, though.
Yeah, I think most people have done that one.
I'm going to be watching this section of the video over and over again. Damn. Let that sink in, Michael. No revenge trading. So we talked a little bit about your trading signal and the methodology. Did you give it a name?
No, not really. No,
I was going to say, next is we got to give you submit for a Nobel Prize, right?
When you talk about what was my best trade, every trade that's a winning trade is my best trade, because it's about accumulating capital. For me, I'll never make $1 million in a day, but I know that I can do that over time. And for me, I've always been what we call a steady Eddie. I would rather make money virtually every day, some money, rather than have a big win one day and a big loss another day. Because for me, that gives you a roller coaster of emotions. Whereas, if you're steadily increasing your capital, effectively almost day by day, when you have that odd down day, and of course, if you've got strong risk capital management in place, you're going to make sure that you only give away a certain amount of your capital in any one day. So you've got to have that maximum risk per day, the same as you would have it per trade, per week, per month, etc. So I can accept that, and when I have a losing trade, which we all do, I never feel bad about it. It's just like a business cost. It's just part and parcel of trading, and of course you have to be able to accept that. But the way I sort of rationalise it is, it's not that I've got a losing trade. It's I've reduced my risk, or I've even removed my risk. So when I go into my trade, I'm 100% confident I'm going to make money. Of course, it doesn't always work that way, but we like to think that. And then, maybe the market does start to go up, but it's not going up fast enough, and I might be holding that trade for hours or something. And I just think, the fundamentals, everything's telling me that this market should have gone up by now. Why isn't it? And I'll think about that long and hard. Now, the moment I start to doubt that is the time probably I'm going to start to reduce the size of my position. So I might take off 25% or 50% of that position. If I suddenly think to myself, well, the market's had so much opportunity to go up because everything's telling it should go up and it hasn't, then I shouldn't be in this position at all. And then I'll get out of it regardless, whether it's a small profit, small loss, I don't care. The market's not doing what it should have done. And if I think, well, if it should have gone up by now and it hasn't, for me, there's only one thing it can do, which is go down. I'll actually reverse my position. I don't do that every time, because just reversing positions isn't like a get out of jail free card, because it just doesn't work like that. And I've got different sort of exercises that I've created around all of these things that I talk about, so that people can practice them to try and help them. But it's just a matter really of practicing that, and sometimes that's going to be the case, and sometimes I'll get out, and then of course it will go. But The majority, at the end of the day, it's about being right more than yours.
Well, yeah, but one thing I say, it's not about being right. It's about making money and not losing money. Because sometimes one of the biggest things where traders lose money is because they're focused on being right. They're like, oh, I need to be right. I need to be right. I need to be right. And they're like, I know this trade idea should happen, but it takes time for it to develop, and they're losing money while they're trying to be right, and I think that's just wrong.
Yeah, no, that's a really good point. Actually, yeah, definitely. It's all about winners to losers, risk reward, for example. So, okay, how do we control our losses? So, before I go into almost any trade, unless I hear some news or something that's going to be market impacting, I'm going to analyze. So I work out where I want to get into my trade. Now, where a lot of people go wrong is, okay, if I get long here, where should I take my profit? Wrong attitude. If I get long here, how much can I lose on this trade? Always look at your potential loss before you look at the potential profit. So if I'm going to get long here, and then if I get stopped out, how much am I prepared to lose on that? So I work out how many ticks or pips it's going to cost me to get out of that. And then once I've done that, that helps me decide the volume, the size of trade I should put on, because I've got to adjust it to make sure that it fits within my risk parameters. Now, the second half is once I've done that and I've established how much I can lose, then I've got to work out what the potential profit's going to be. Once I've worked that out, that gives me my risk reward.
And I guess talking a little bit about risk, how do you go about managing risk and the risk reward, and how do you think it relates to trading psychology?
Well, for risk reward and trading psychology, so with risk reward, it's about having. For me, I won't go into a trade unless it's got at least a 2-to-1 risk reward ratio. And then it doesn't mean I'll only take 2-to-1, but it means that's the minimum I'm going to take is 2-to-1. And then the other side of that is going to be sorry, I've just seen I've got a low battery. I need to just plug in my electrics. Just give me
no problem.
Give me 2 minutes.
Please stay with us while we plug in over the next minute or two. We will be right back with you, everyone. Good time for a water break, though, right? And for anyone who's watching the World Cup, I think we're almost set for the round of 16 very shortly.
Apologies about that. So
no worries. We're back.
Yeah. It's just I changed onto the tablet, so everything else is plugged in on the electrics, but this wasn't. So, okay, so I'm back now. So, so when it comes to those sort of areas, for me, risk reward is really important because your risk reward impacts your winners to losers. And that becomes really important as well, because if I'm taking a minimum of 2 to 1 for my risk reward, then when, as an example, if I was only right 50% of the time, I'll still make money.
Yeah, well, setting risk to reward, like I was looking to set some trades the other day, and I was like, okay, I always look for at least 2 to 1 as well. And I was like, you know what? I'm only looking for 30 pips, and then there's like 10, 15 pips. And I was like, I don't know, is that too short, too small of a range to really just be looking for? Is there like? I was like, maybe I don't take this trade because like it's really easy for the market to go back 10, 15 pips. So it's just like I'm like even though it's a 2 to 1 trade, the probability of that retracing a little bit is pretty high. And I was like, let's leave that trade off. Don't take it.
Well, yeah, and let's be honest. The majority, probably 75, 85% of our trades will go against us before they go for us, if they're going to go for us.
Exactly.
And of course, it's a matter of how far it goes against us to whether we can afford to stay in that trade or not. I've got something that I call the 3 Vs, which is volume versus volatility, which comes back to my risk reward again. So the more volatile the market, I reduce the size of my trade down. And then that allows me to have a wider stop, but without actually increasing the overall potential loss.
Smart. Smaller, just go for a smaller lot size and play the bigger range.
Exactly.
Without increasing risks, keeping it all the same.
Yeah, the only thing you have to be careful of there is if you're going to widen your stop, you've got to make sure your risk reward is still there. Okay, I'll have my stop 100 points away, but can you get 200 points out of the market? Is the market going to give you that in a day? So you've got to be realistic with both sides of that.
Yeah, that's very true as well. You're like, yeah. Oh, trading, never easy. Never easy. Well, I guess let's go into trading plan and what makes a what do you consider? What do you put into a trading plan?
Yeah, so for me, there's 2 parts to a trading plan, and again, it depends on how people are. Whether they're utilising their own capital or whether they're using, say, your capital through Nordic Funder. So if you're using your own capital, then it becomes a little bit more sort of, you've got to be more structured with it. You've got to be more and more cautious about how you manage your trades. Obviously, however you're trading, you've got to be aware of them because you want to be in a position where you're increasing your capital regularly and not taking the big hits. So again, it comes back to controlling the losses for sure.
And do you include psychology into the trade plan, like what you were thinking about, how you're feeling, or is that like more journaling?
Well, I think if you've got a solid trade plan, it actually removes a lot of the emotion. So for me, the trade plan's broken into 2. You've got the financial setup, and then you've got the actual trade setup. So in the financials, what's the most you're prepared to lose in a trade? What's the most you're prepared to lose in a day, a week, a month, etc. And that becomes part of it. And then once you've established that, that's the financial element of it. The second part is your trade setup. Making sure that you follow a strict set of rules in building up your strategy and your day, your trading day even. It's good to have a routine because that way you don't miss anything. So, for me, the first thing I do is I read loads of reports. Then I do my analysis and I prepare myself. And, before I trade, well, when I'm sitting there, I can click buttons, great, but does that mean I'm going to make money? No, there's got to be a purpose to it. I need to be focused. So when I sit in front of my screen, before I start clicking my buttons and putting orders in, I ask myself, am I ready to trade today? And that's one of my rules. And if I can't answer yes, then I'll go away and perhaps chill out for 10 minutes, come back, and then now am I focused? Now am I ready? Because otherwise you tend to rush your trades, and you shouldn't be doing that.
And you mentioned you read your reports. Is there where do you like to read your information from, or what reports do you get? Maybe there's some public information out there that we don't know about.
I'm subscribed to a lot of Bloomberg. I get it from ING. I've got 2 or 3 brokers that we use that send us lots of information as well, friends and such like. So I sort of collate all of that because I put out a morning daily newsletter. I have to go through all this to filter it, to work out what's potentially market relevant, shall we say, because it's info overload out there. There's so much information available, but at the end of the day, what is relevant to your market? What is relevant to the market? And then it's just a matter of filtering that out and just putting in what I feel is going to perhaps impact the market, whether it's today or in the future. Looking at the central banks, looking at the governments, looking at the data, all of that, and of course just trends and what's going on around all the different asset classes. But you've got to build up that picture. So I very much focus on the fundamentals. What I always say is the fundamentals that determine trend and direction and even volatility. But we use the technicals because the technicals help us with our timing, with our interests. We can be right, as you were saying earlier, you can be right on where the market goes by the end of the day or the end of the week or the end of the month. But does that mean you've always made money? And the answer to that is no. Because if our timing sucks, then we get stopped out before the market turns around.
Yeah, I guess let's maybe jump into some current events and what's going on. I guess what are your thoughts on the UK currently?
Well, I'm based in the UK, so politically wise, not in a great place. I mean, the Tory government's effectively been backstabbing their leaders time and time again. Hopefully we can keep this one a bit longer than I think 6 weeks. I think the last one lasted, which, British politics, I mean, it's unheard of. We get these sort of things happen. But, in the UK, the leader and the chancellor at the moment that we do have are for austerity. As we're going into recession, so that doesn't bode well for the UK. Even the head of the Bank of England came out and said that we're heading for a deep recession, but also one that's going to be long, so it's going to last longer. However, that said, you walk into the shops full of people shopping.
Yeah, that's true. You have lots of foreign money over there and foreigners living there, so I don't say that always reflects the true demographics of what people are feeling in the cities and towns around like the metropolitan.
Yeah, no, absolutely. I mean, you're talking about that 1 to 5% that's got that affordability of luxury of buying what they want to, and then everybody else has to struggle. And this year, because of inflation, more than ever, households have had to sort of balance and work out what's important. And it's one of the reasons you've seen the tech companies sort of really sort of not take off this year. I mean, over COVID, they benefited more than anybody. But there's been a real sort of reversal this year. That struggle because where people are feeling and having to make decisions on how they spend their money within the household. I've got a phone that works, or I've got a pad that works, or I've got a laptop that works. I want the latest one, but actually I'll wait another year before I buy that. So that's impacting the tech side.
And like I guess like I would say like we're in an environment that represents stagflation currently. We're going into really high interest rates. We're going into very everything is more expensive. The price of high inflation, high interest rates, but everything's getting more expensive. But the cost of living is increasing, and now you're talking about heading into a deep recession. what are things going to look like? How does that look? How does that look? How does that play out? We also had the pound at 1.05, and now it's at 1.20 something. Like that's a huge 15-cent jump in less than 90 days.
Yeah, but to be honest, that's more through dollar weakness than it is through pound strength. There's probably about 1 to 5% of that is actually based on the pound. The rest of it's all just dollar weakness. You look at the euro; it was down in the 97s, below sort of 1, and now it's back up at 103, 104. So, but in Europe as such, and again, we've got to look at different areas. So if you look at the UK and Europe, it's going to really depend on temperatures. It's going to depend on how much people are going to have to spend on their heating, on their food, what disposable income they've got left after that, if any. As I was saying, there's different levels within the structure of an economy, and the people that are on low and even mid incomes will struggle potentially over winter if it's a very sort of harsh winter. Now, in the UK, we do have this situation where we've got a price energy cap, but the new Prime Minister raised that up, and it's still based on usage. So basically, they haven't said, okay, each household can only spend so much on their energy. What's actually capped is the unit of energy. So the more you use, the more you're still going to pay, which makes sense. But that cap has moved up in October. So, we're likely to see another little bump in inflation because of that. And in March, April next year, it's going to go up again. So you're going to see another bump in inflation coming sort of as that feeds in 2 months after that. So I think temperatures are going to be really, really important for Europe as a whole, because obviously it comes back down to the Russians' invasion of Ukraine and the Russians turning the gas off to Europe pretty much.
Yeah, I'm starting to see like $20 for a gallon of milk. I'm gonna buy a cow. Like, what the heck?
You obviously drink a lot of milk then.
My wife likes milk and smoothies and all that stuff. So yeah.
Right, and then so I think Europe is sort of in a more delicate situation than America. I always say America's almost like self-sufficient. It's got plenty of energy and it's got plenty of food because it creates that itself. It's all internal. So, again, if you go back on energy in America, up until 2012, I think it was actually illegal to export WTI oil outside the country. It was only because of the fracking industry, which allowed them to source all this additional oil and gas, and it took them from being a sort of quite a big net importer of oil to one of the major exporters of oil. Well, obviously, COVID sort of had an impact because oil prices, WTI prices, actually went negative for the first time in its history in sort of May time of 2020. It was like the perfect storm because on one side you had sort of demand destruction because everyone was locked down, but at the same time, just prior to that, because Russia wouldn't agree to any quotas, the Saudis went from reducing their quota to actually increasing it by 1.5 million barrels a day, and that created the perfect storm. And of course, price of oil just absolutely crashed, and it went negative to almost $40.
Yeah, and I guess the central banks' interest rates. Well, what does that look like?
So Powell had his speech yesterday, and he was saying that the increases are still coming, but at a slower pace. For the Fed especially, they were so far behind the curve at the beginning of the year. And I think central banks, look at my history on what I think about central banks. But quantitative easing, I just totally disagree with. It's the easiest solution. It's not the best solution.
It's the opposite of capitalism, quantitative easing. Like capitalism is let it fail and the strong survive. Quantitative easing is, support everything, kind of like you're holding it up. So
yeah, inflate everything. So when you look at central banks doing that, aren't they the biggest manipulators of the market?
Yeah, I'd say policies are the biggest factor. Well, you said earlier that Canada and the U.S. are very energy independent, but at the same time, with all of the green deals that are going on and stuff like that, there's all these taxes on energy that are lifting the price of energy and living up in North America. So, we might not be dependent on Russia, but there's all these taxes coming in that are like they're devastating to the everyday people.
Yeah, and on top of that, when you look at the oil companies, what is really their incentive to go and source more oil? Because they see it as a declining industry. Even the majority of them are looking for alternatives, solar power, looking for different energy sources so that they can replace their business and slowly sort of move away from carbon themselves. But there's a massive cost for that. And, if you look back over the decades and COP27 and everything else, all this commitment to going green is fantastic. But a lot of it's just talk. And why is it just talk? It's because the cost is phenomenal. You're talking hundreds of trillions of dollars to turn this planet green. And of course, nobody minds that as long as they haven't got to pay for it.
Well, yeah, no one wants to sacrifice their way of life, so yeah, that totally makes sense.
Yeah, but even industry wants it, but they don't want to pay for it.
Correct. Well, we've all got to pay for it one way or another. I'm reading Mark Carney, the book about values right now, and we place a value on everything, but we don't place a value on the quality of life that we have, like we're at the earth and the nature, and I think that is something we definitely have to think about, because we can't just going about being negligent. So I see both sides to the argument, and I think there's got to be a middle ground and a way forward, and hopefully we'll figure it out. But I'd like to get back to dissecting what Powell said, because yesterday you had the Dow Jones move 1,000 points pretty much for between top and bottom, and they're saying they're still going to go forward with interest rates, but at a slower pace. I'm like, but it's just instead of it being super harsh, it's going to be longer and harsher. So
yeah,
I don't know. I'd rather it be quick. I'd rather it be quick, hard, and then go back to lowering it after you flush everything out. Now it's a slow burn.
Yeah, I mean, they're going to become more paced now, because as I was saying, they were so far behind the curve. I did a webinar on this some time ago that central banks became too transparent. And because they was frightened of the markets reacting badly to what they say and what they do, they just open up and tell everybody everything about what their intentions are, what their metrics are and everything. And that put Powell in a bad position last year, because the metrics that he put together to change in policy, one of them, okay, we want inflation up, tick, 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 for sure, because that just took off. And other elements to it as well. But the one that he struggled with was getting employment levels back to pre-COVID. And so it delayed them from tapering. Whereas ideally, if he hadn't have actually come out and openly said what his metrics were going to be, that it would have given them the flexibility to have tapered by the end of December last year, and even had their first rate hike at the beginning of December at their last meeting, as we're coming up to in a couple of weeks' time this year, and put rates up. That would have been their first one, and then they could have gone at a much steadier pace. But because they missed that sort of first 3-4 months of the year, this year they had to go at a faster pace to try and play catch up. And that's why we had all these 75-point moves. Now, going forward from here, inflation's still well above what they want. You know, the optimum level for central banks in the Western world is 2%. When are they going to get that? You know, we had PCE data out today. That came out, it was pleasantly better than expected, but it's still 5%. You know, and that's one of the key metrics for Powell. So 5% is still not 2%. And that's why they're going to keep going. And, you know, my take on it is that if their number one priority is getting inflation back under control. They can control the supply side by keep putting these rates up. But at the end of the day, that doesn't solve the supply issues, which has been the biggest driver of inflation over this last year. So they're going to put these rates up and they're going to keep creeping them up. Sometime in 2023, hopefully they get inflation back to 2%. But does that mean they're going to suddenly start cutting rates? And the answer is no. They're going to leave rates higher for longer. So once inflation starts to come back down to that 2%, they will hold the rates there, I reckon, for between 3 and 6 months, because they'll want to see that consistency in that inflation. They've now become frightened of inflation. It's not something they've had to deal with for the last 2 decades. And then all of a sudden it's came and just bitten them very, very sharply, because it's all just taken off through COVID and all the supply chain issues that we've had. Now, the supply side is one, and they can control that demand, but they can't suddenly stop Russia invading Ukraine. They can't grow more crops. They can't make food prices come down. They couldn't solve the semiconductor shortage that we had that was inflating as well. So, and creating more cargo ships. So there's so many different factors to that. And for me, that's why the only way that they can reset the economy is to drive it into recession, or, as you said earlier, an absolute minimum of stagflation, you know, where you've got inflation without any growth.
Yeah, and I'm trying to understand why the U.S. is getting weaker. They're still raising rates. They still have the highest rates than anyone, and they're still raising rates faster, more aggressive than anyone else. Why? What's the explanation for why they've been giving up strength?
Well, so the stock market looks at the fact that they're going to slow down the increases as a positive for them. Mm-hmm. But I think investors sometimes get a little bit too excited just by looking at interest rates. So if interest rates are going to be slowed down and they're not going to go at the same pace of the 75, which makes sense and it's obvious really, then you've got to look at why aren't they going to go as aggressively. It's because inflation is already starting to just, you know, considered to be peaked in the US and started to come down. In Europe, I'm not so sure it's peaked yet. I think it's probably got 1, maybe 2 more spikes to go. So in the US, we've had that peak and it's coming down. So investors feel comfortable going back in because it means that the companies and households, the pain that they've endured over this last 6 months of all these massive hikes is coming to an end. Earnings have gone up because of a shortage of labour coming from sort of like the baby boomers and everything. But for me, you know, there's a lot of jobs available out there, or supposedly out there. And you know, in the US, it went up to practically 2 to 1. There was 2 jobs available for every person that was unemployed. And then it dropped off to 1.65%. And then last time it was back up to 1.9%. But, you know, the economy's good, And the US put so much stimulus in that theirs is much better than anybody else's, but it is still slowly coming down. So for me, demand is coming down, which means that companies aren't going to need to keep taking on more staff. The big question is going to be, if there is a recession, or at least stagflation, absolute bare minimum, is are these companies prepared to shed workforce when they've struggled so much to actually attract them this year?
Oh, that's interesting. That's an interesting point. And we're rounding it up, close to the end. Do you have any trade ideas for the next few months that are things that are looking at, that you're looking at?
Yeah, I mean, for me, one of my key things that I look at is the dollar index. Just looking at the dollar, yes, it's been weakening. It's off the highs of 111 down. It's going to test the 105s by the looks of things, but I'm not sure it's, I wouldn't say the dollar's finished by any means, because they've still got the best economy. They're going to more likely have one of the shallowest recessions out of everybody. Europe, UK, probably one of the deepest. Again, it's just going to come back to these temperatures, to how much of an impact that's going to have for us. Now, that's sort of one area I'm looking at. So I've been bullish of the dollar for the last 2-3 years. So I've been a bit more cautious about those long positions now. But I think, I'm still inclined to buy the dips rather than sell the rallies on the dollar. And then other areas I'm looking at, gold a little, but much more oil, because I think with oil there's so much potential. It's been so volatile. It's been an amazing year for oil. I trade more for oil through strategies than I do through outrights, because they move at a slower pace. That gives me that extra, because of the volatility, it gives me a little bit more time to stay in my trades.
Very cool. And how can people get in touch with you and learn more about Symax fintech?
I mean, we'd love to hear from people just to get some feedback. We're always available to answer questions. So we've got our website for anyone who wants to look at courses, and that's going to come up at the end of this, I believe. But then if anybody wants to reach out to me just to ask me any trading questions, I'm happy for them to email me directly, which is chris.tubby@symax-int.com. Always, I love hearing from people. I mean, trading's just been so much of my life that, if I can pass on my knowledge to the new guys coming through. And again, when you look at sort of what happened over COVID, over 22 million new traders entered the market in less than 2 years.
Yeah, and I know you mentioned when we met last week while we were in London, you said you also do daily mentoring sessions with people who want to learn. And after listening to you today, spending a day with Chris, you'll get 40 years of knowledge and trading many different markets. Like, this has been fantastic, Chris. I really appreciate you joining us. Thank you so much.
No, you're welcome. And yes, I mean, we do workshops to help people fill in their gaps. We do courses and master classes. We even do an accredited one for anybody that actually sort of wants to get that diploma on their wall, which will give them a deep understanding of the fundamentals, technicals of risk management. And of course, they get to spend at least 20 trading practice sessions with me. And yeah, I mean, we do a Sunday evening YouTube as well, so that helps traders prepare for the week ahead. And of course, for us, I just love. I've got so much passion for trading. I've got more today than probably the first day I started. And for me, if I can pass that knowledge on, then that's great, because I want that, obviously, that continuation of people coming through and hopefully being successful at trading.
Sweet, appreciate it. Well, thank you for joining, Chris, and I think that's it for today's Trading WTF, where to focus. And you know where to find Chris if you have any other questions. Thank you so much, Chris.
Thank you. Thank you for inviting me. Good luck, everybody. Have a great Christmas.
Yeah, happy holidays.